Welcome to the deep dive, Financial Markets. They're this fascinating world of huge opportunity, right? But for machine learning, they've always been, well, uniquely challenging, almost infuriatingly so. Predicting price movements is just notoriously hard. So our mission today is to really get into a very insightful paper. It's called Conservative Predictions on Noisy Financial Data by Omkar Nabar and Gautam Shroff from the 4th ACM International Conference on AI and Finance. And the core problem, the thing they're tackling is this. Financial markets are just incredibly noisy. That noise can totally swamp even patterns you could exploit, making it super difficult for AI to find them, let alone use them reliably. And yet we all know or hear stories about these expert human traders who seem to consistently do better, that almost seem to defy that whole efficient market hypothesis. Makes you wonder, right? Is there like an art to seeing these fleeting patterns through all the static?
Absolutely. And what's really key here is that this inherent noisiness, it often pushes machine learning models to make predictions that are just plain wrong. And in finance, wrong means risky, very risky. So this deep dive, we're going to explore how these authors came up with a really novel, maybe even counterintuitive idea. A way for models to basically say, you know what, I actually don't know on this one. And for something with stakes as high as financial trading, that ability, well, it's potentially a real game changer. The breakthrough here isn't just how to predict, it's mastering the art of knowing when not to predict. It sounds strange, but that kind of humility might just be AI's superpower in high-stakes finance.
That makes a lot of sense, actually. Yeah.
Yeah.
And it really brings home how this deep dive is sort of your shortcut to understanding how researchers are trying to make AI in finance, well, less of a gamble, more practical. And you're going to hear something pretty surprising sometimes. A model just deciding not to predict anything.
Yeah.
That can actually be his biggest strength. Okay, so if some humans can navigate this, why is it so tough for our, sophisticated AI? What makes financial data this unique beast compared to, say, image recognition or language where AI is doing amazing things?
Yeah, it fundamentally boils down to what the paper calls feature and label noise. It's everywhere. So even if there are some short-lived patterns, this constant noise just clouds everything up. It's like trying to hear a whisper in a really loud room. It makes any predictions you do make less useful and inherently riskier. And it really challenges that classic efficient market hypothesis, which basically says it's all noise, no consistent signal. Now, people have tried to tackle noise before in ML. Some traditional ways involved custom loss functions, which basically change how the model learns from mistakes when there's noise, or techniques like bootstrapping, where you kind of create variations of your data to make the model more robust.
Right. So this idea of dealing with noise, or maybe a model holding back, it isn't totally new then. Did those earlier approaches, like you mentioned, bootstrapping, or maybe things like that CN2 algorithm in the outline, give clues? Why didn't they fully crack it for finance?
Exactly. The problem itself isn't new. You mentioned the CN2 rule learning algorithm. That's a good historical example. It was developed specifically to handle noisy data. It learned rules that were highly accurate, but here's the kicker. It only applied them to a fraction of the data. If a rule didn't clearly fit, it just refrained. It didn't like a prediction. And this idea of abstaining, holding back, is so critical when the stakes are high, like in trading. Plus, other researchers argue that overly complex models in finance often just learn the noise patterns, not the real signal, which sort of highlights why simpler, maybe rule-based approaches could have an edge here. What's different, I think, in this paper is how they structure this abstention within a sequence of models. It's a more layered approach.
Huh. It sounds like maybe the oldest advice in trading, sometimes the best trade is no trade, is actually finding its way into AI design. But how do you actually build a model that knows when to be humble? That's the interesting part we're getting to. Okay, this is where it gets really interesting, I think. The paper's big idea revolves around cascading models. So what exactly is a cascade in this context?
Well, they drew inspiration from three main ideas floating around in prior work. First, the benefit of using simpler, maybe rule-based models we just talked about. Second, this concept of learning a sequence of models where each one is trained on progressively smaller bits of the data. And third, this is the crucial part, deliberately not making a prediction if any model along that chain isn't sure.
So the cascade works like this. You train a model. Then you look at the data points where that first model was uncertain, and you train the next model only on those uncertain points. It's kind of like having levels of specialists. The first one takes a look at it, I'm not sure, it goes to the next expert down the line.
Okay, so it sets its own bar for confidence, but how do they actually measure uncertainty for an ML model here? You mentioned Gini index in the outline. How does that work? And is that maximum purity something they just picked, or did the model figure it out? Right, they use the Gini index on the predicted class probabilities. You can think of the Gini index as basically a measure of how mixed up the prediction is. Impurity, sort of. So if the model is really confident, like 90% sure it's buy and only 10% sell, the Gini index is low. Low impurity.
Right, high confidence.
Exactly. But if it's like 50-50, totally unsure, then the Gini index is high. High impurity. So they set a threshold, a maximum admissible impurity. And yes, that is a predefined parameter they have to tune. If the model's Gini score for a data point is above that threshold, it basically says pass. It abstains or prunes that data point.
Right.
And then those pruned uncertain points, they become the training set for the next model in the cascade. The huge benefit here, the payoff, is that decisions only get made when the whole ensemble feels confident. And that directly cuts down risk. It's better, they argue, to have maybe 70% accuracy on just 10% or 20% of the data, the bits where it's really sure, and just abstain on the rest. That's preferable for minimizing risk in finance. In their experiments, they mostly used a 3-level cascade.
Okay, so it's definitely about quality over quantity for predictions.
Like so.
So what were the actual ML models they put inside these cascade layers? What kind of brains were doing the work?
They experimented with 2 main types. First, standard multi-layer perceptrons, MLPs, your typical neural network building blocks. And second, something called differentiable decision trees, or DDTs.
DDTs, okay, what are those?
So they're kind of a twist on classic decision trees. Normal decision trees make hard splits at each node, right? Like if RSI 70, go left. DDTs use fuzzy decisions instead, using sigmoid functions like neural networks use. This makes the whole tree differentiable, meaning you can train it using gradient descent, just like an MLP. It lets them potentially capture more subtle patterns than rigid rules, but maybe offer a bit more interpretability than a pure black box MLP.
Interesting mix. So they have this clever cascade setup. They've got MLPs and these DDTs.
Mm-hmm.
How did they actually test if it worked? What kind of data did they throw at it? And what features were they looking at?
Good question. They used 2 main kinds of data to be thorough. First, real market data. They used 5-minute OHLCV, that's open, high, low, close volume for stocks on the Indian market, normalized daily. But second, and this was smart, they also generated synthetic data. This was basically sine waves, with different speeds and heights. But crucially, they added varying amounts of noise to it. Controlled noise that let them really systematically study how models held up as things got noisier and noisier.
Okay, so they could isolate the noise factor.
Right.
What about the inputs, the features?
Yeah, they used a mix of standard technical indicators that traders use, moving averages, RSI, MACD, Bollinger Bands, things like that. But they also engineered some unique ones they called logical and temporal features. Things like the difference between the open and close price, the slope of the closing price over a few candles, and something called change lengths, basically. How many candles in a row a feature kept going up or down. And the target, what they were trying to predict, was the return over the next 10 candles. So the price change between time t and 10 plus 50 minutes. And importantly, they discretized everything, all the input features, and that target return into 5 bins, equally populated bins.
Okay, so turning it into a classification problem, which of the 5 bins will the return fall into?
Exactly. Predict the category, not the exact number. Often makes things more robust, especially with noise.
Right, so they run the experiments with the real data, the synthetic data, the cascades versus single models. What did they find? How did these cascading models actually perform when the rubber hit the road? Was there a big surprise?
Well, some things weren't surprising. Performance generally went down as noise went up. That's expected. But the key finding was that the cascaded models did offer real, tangible improvement in test set performance compared to just using a single MLP or DD2 on its own. But here's the really cool part, the aha moment, I think. When they looked at the confusion matrices, which show what the model predicted versus what actually happened for the test data, they saw that the predictions the cascade actually made, the ones it didn't abstain on, were overwhelmingly concentrated at the extremes, classes 0 or 4.
Meaning strong down moves or strong up moves.
Precisely, which is exactly what a trader wants signals for. You want to know when to sell short, class 0, or buy long, class 4. You're less interested in the model being super confident about the market just staying flat. And this outcome, focusing on the extremes, it wasn't guaranteed by the method, it just sort of emerged from the process. That makes it particularly significant. They also found, interestingly, that while the cascading MLPs did well on the synthetic data, the cascading DDTs often had higher accuracy, although on fewer data points, lower support, when using the real market data. Oh, and one caveat. They did note that on smaller data sets covering just a single market era, the models sometimes overfit, and the benefit of cascading was less pronounced there.
Okay, that finding about predicting the extremes is really fascinating. Why is that specific outcome, predicting extremes well and abstaining otherwise, so crucial when you think about actually using this for trading?
Ah, well, it gets right to the heart of risk in trading. See, it's not just about maximizing your average return. It's maybe even more about avoiding those catastrophic losses, what traders call drawdowns. If you're using leverage, a big intermediate loss can trigger a margin call, which can completely wipe out your capital. It's game over.
Right, the risk of ruin.
Exactly. So strategies that are really good at avoiding those big hits, even if their average return looks slightly lower on paper, they actually allow a trader to commit more capital or use more leverage safely, which paradoxically can lead to higher overall returns in practice because you've drastically cut the risk of getting knocked out of the game.
Okay, that makes perfect sense. So avoiding the big mistakes is paramount. Given that, what specific metrics did they use in the paper to capture this balance between gain and, well, not losing your shirt, beyond just prediction accuracy?
Yeah, they used some specialized metrics tailored for this. First was utility. This measures the average gain per trade, but, and this is key, it only looks at trades based on predicting the extremes, class 0 or 4. So, for instance, if you correctly predict class 0, strong down, and the market does go down strongly, ground truth is 0, you get +2 utility for that successful short. Other outcomes get different scores. Then they used downside risk-adjusted return, or DRR. That's calculated simply as gain-loss, loss, so it directly penalizes losses.
Okay.
And finally, the traded Sharpe ratio. It's like the standard Sharpe ratio, return over risk, but calculated only for the trades the model actually recommended again when it predicted class 0 or 4. So all these metrics focus on the performance of the actionable predictions, the ones you'd actually trade on, while accounting for risk.
Right, focusing on what matters for actual trading outcomes. So the million-dollar question then, did this whole cascading, abstaining approach measured by these metrics, did it actually deliver? Did it lead to better returns for the risk taken?
Yes, absolutely. That was the payoff. The results, especially using these risk-adjusted metrics like utility, DRR, and traded Sharpe, they showed pretty clearly that the cascaded DDTs performed significantly better than the basic single models in all their test cases. And often, they did better than the cascaded MLPs too, although there were some mixed results on the market data there. But the overall conclusion holds. The approach is, as they put it, likely to result in better overall returns at a lower level of risk. It works by basically recommending fewer trades, but making sure those trades are higher quality, more likely to succeed, and less likely to result in those big damaging losses. It really validates this whole idea of intelligent abstention.
So what we've really unpacked today is, I think, a genuinely innovative way to grapple with that constant frustrating noise in financial markets. It's shifted the focus, hasn't it?
Yeah.
Not just predicting accurately, but predicting confidently and, crucially, knowing when the smartest move is just to stay out.
Precisely. The core message is that by zeroing in on those high-utility, high-confidence predictions, especially at the market extremes, these cascading models, and particularly the differentiable decision tree versions, they really do improve those risk-adjusted returns. They cut down your exposure to the really bad outcomes. It's about cultivating a kind of smart, calculated confidence in the model's predictions.
It leaves you with a fascinating thought, though. The paper itself mentions that performance can drop off when you test models on market conditions or eras that are different from what they were trained on, which makes sense. Markets evolve. So if financial markets are always shifting, always changing, how does this idea of conservative prediction need to adapt? Is the future of AI in finance all about getting even smarter at abstaining? Or is it more about continuous adaptive learning? Or maybe some blend of both? And maybe for you listening, think about how this core idea, making confident predictions on just a fraction of the data, might apply elsewhere. Could it be useful in other noisy, high-stakes situations? Or even just dealing with information overload in your own work or life? Something to mull over.